I would love to see the industry work like the mafia and just not drop rate. Like really, we're under tariff. You know, there's not enough of it to go around. So operators absolutely should be holding rate.
There's some markets they'll charge $100 for a night, but $30 goes towards a cleaner. You know, and then you add in electricity and water and all the other costs. And all of a sudden, you're not making a lot of money.
The crucial thing to any valuation is certainty, whether it's middle of the pack in terms of the yield that's been achieved or if it's at the top end. You need to make sure that it's justifiable.
Welcome to Resort Brokers Radio. I'm Trudy. We're going to walk you through the ever-evolving landscapes of hotels, motels, caravan parks and management rights. Here we have experts from all across the accommodation industry, and we've invited them along to tell us all about their success stories, the lessons they've learnt, what their predictions are for the market going forward and what trends they're seeing. Please join us. We look forward to seeing you there. Today we're going to be talking about the first ever industry motel report. We have just finished the roadshow across the country, which has been a huge success, as this has been the first in-depth study ever done on the motel industry. Resort Brokers is very passionate about all accommodation, but we started in the motel game. We grew up in motels, so they're very close to our heart. And it's the fabulous Josh Mangelson, who gets all the credit for this. Josh, thank you for joining me again.
Pleasure. Thanks.
What a report. How fantastic.
Yeah, we've had some great feedback from it.
We have.
Yeah, hopefully it only gets better next year.
Yeah, absolutely. We're not here alone.
No, that's right. So we are joined by two of our three data partners from this edition of the report. Acumentus wasn't able to join us, but they send our regards. But we have Ryan Danaher from Option, Head of Alternate Investments based in Melbourne, and Jordan Hayes, Director, Valuation and Advisory Services at Knight Frank. So thank you, gentlemen, for your contributions, and thanks for joining us.
Thanks for having us.
Thank you.
Yeah, thank you so much. I mean, really, it's the first, well, look, I think the management rights report, which we're now up to our fourth or fifth?
Yeah, fourth, yeah.
Fourth version, fourth year.
Yes.
And now it's very much considered, the absolute gospel in regards to that industry. This has been even more in depth than that, but we couldn't do it without you guys. So we really thank you, because it's a huge thing for you to be so generous as to give us your data. Obviously, we're very aware that that's your IP, you know, that's your intel, and it's under lock and key, but we really appreciate it. So thank you.
Yes.
And we hope to have you join us next year for it. So tell us, what did you think of the report? You guys would read a lot of industry reports. What was your thoughts?
Yeah, it certainly, I think from my side, highlighted the scale of the industry. You get a fairly narrow focus from the Val side. As much as you like to think you're across all the data, you know, you're only getting probably a quarter of a percentage of the work that's out there in the industry. So to see it combined into a singular report certainly highlights just how much is out there and how important this industry is to the economy.
Yeah, agreed. Partnerships like these are really important to specialised valuation firms because we just don't have time, a lot of the time, to accumulate all that data outside of our own group and analyse it in great detail. So it's a really important partnership.
Yeah, well, thank you. And in regards to the actual numbers in there, so I have used it exactly like you say, Jordan. I've used it so much since it's been in the industry, since I've been able to, and everyone who's not in the space can't believe the scale of the industry, and everybody who is in it feels very, very happy to have something that they can revert back to and see where they're sitting, where their purchases are sitting. I mean, don't get me wrong, the market's moving so incredibly quickly that even when we were launching it over the last month, you know, there's deals that are happening that are much tighter than the average already. So I think next year's, because it couldn't be better time, because the market's never been moving so fast and there's never been so much activity. And, I sold my first motel 23 years ago. I've never seen activity like it.
Yeah, I think you're right, and I think for us it's almost a line in the sand moment where we've got some physical data there that in a year, 2, 5 years' time we're going to be referring back to in terms of where were occupancy rates, where were ADRs, how many transactions were occurring in the market, and we haven't been able to gauge that until something like this has been put together.
I also think there's been a lot of off-market opportunities or deals that unfortunately none of us have been privy to, that we are working to get those data partners to, so we can really make the report as robust as possible year after year. In regards to the numbers, what do you think was the most interesting thing? Were the yields sitting where you thought they would?
Yeah, it was interesting. I think there's been plenty of tourist areas, I think, where the yield spread between a freehold and a freehold going concern has been tightening over years in those really strong tourism sectors.
Yes.
But it was interesting to see that gap was actually quite close across the board, and it was actually tightening. So we see a lot more transactions these days where we're marrying the freehold and business interest, tightening those up, and that's because that yield spread is getting tighter and tighter.
Exactly.
Yeah, I think we're at a pretty critical point in the market too. You look at what's happening with leasehold yields at the moment, and the old 30% benchmark, which was set in stone for such a long time. It's starting to drop off in the rearview mirror at the moment, and
Without a doubt.
every transaction that's landing on our desk, and look, there are exceptions. There's no doubt about that, but we're just seeing that tightening. So, like I said, to refer back to this report in 12 months' time, I don't think you gauge just how quickly the market's moving sometimes when you're active in it every day. But to refer back to a set of numbers 12 months down the track will be very interesting to see.
Do you know, I couldn't agree more with you about the leases because, I reckon probably coming out of COVID, and I hate to even talk about it, but coming out of COVID, there was definitely a drive towards freehold going concerns, and I reckon that's probably twofold. Obviously, leasehold with the code that came in were probably maybe a little bit out of favour because they'd had such a focus during that time, but also I think because there was a new type of buyer that came about who just realised, and I call them real estate play buyers, which was never the traditional motel buyer. They were always bought by people who are looking to buy a business and somewhere to live and wanted to get into the industry, and they often bought leases. But, when there was a lot of people who realised the price to buy the whole thing and just realised it represented good value without even knowing what you could generate from it and what yield you need to buy them on or what you should be expecting. I think that created a lot of heat. So we went around for about 3 years really focusing on putting them back together.
Yep.
Exactly what you said. And now we're seeing leaseholds come back into favour, and I think the housing crisis has really amped that up, so which is one of the things that obviously was traditionally made leases appealing, making them appealing again. But then I agree with you, the yields are so tight now. It used to always be that it was 30% and 9%, and that made the freeholds 14.6, so 14.5 to 15, and it was that pretty much unless you were really regional or really remote. Like some parts of the territory, some parts in WA, but really remote. Apart from that, it was pretty cookie cutter, and now we're seeing lots of leases sitting between 22, 25%.
Yeah, well, I mean, it's still a good return though, isn't it? Like, as businesses go, and as you say, cost of living pressures, you buy a roof over your head, you buy a property generally in a pretty good location, if people are looking for that lifestyle, and you still get a cracking return. So you can see why they're still attractive even at sub 30%.
Totally. Tell me, compared to other asset classes or other businesses that you're buying, how do they compare to an owner-operated business? Can you think of any businesses where the yields like?
Oh, look, I think, and it's probably reflective of the bank's appetite to lend in these spaces. Is the returns are solid, but they're also considered secure.
Isn't that interesting? Because it was left to centre.
It is, yeah.
Yeah.
And look, I think, you probably touched on one element of it before in the housing shortage at the moment. And I think the motel industry in particular has got a big part to play in addressing that over the next few years. But look, certainly from the bank side, there seems to be a level of comfort and a level of security around these assets that, the yields, yes, they're far more attractive than we're seeing in other asset classes, but the risk probably doesn't reflect the higher level of return that's there.
It's so interesting because I know, particularly in the hotel end of the market, or big motel end of the market where you've got more commercial money.
Yep.
It was always seen a little bit not a traditional asset class to invest in, not like other commercial or industrial or something, which was considered safer. But hasn't that turned on its head? Yeah.
Well, you look at the yields in those sectors of the market, and we're talking 10 to 14% for free going concerns, or 20 to 30% for leaseholds. You're well and truly still sub 7% for a general commercial investment yield in the southeast Queensland market at the moment.
Yeah. Wow.
There's a big gap.
So do you think then, maybe this isn't the right question to ask values, but do you think then we'll continue to see compression?
It's hard to say. I think in certain sectors there's a push towards institutional type management, and management's ultimately really important for what we do. We look for average competent management. We don't try and look too far into the future. We look for the here and now, and what sustainable revenues and profits can be maintained. ADRs have gone through the roof.
Yep.
Occupancy's generally pulled back, and we try and look for what that balance is going forward and what can be maintainable. So there's still a balance of what we can do, really.
Do you know what? And I totally understand and respect that, and we're the same.
Yeah.
The past has pretty much predicted the future, not so much in the last few years, because no one could foresee what happened, but we're exactly the same. We don't want a crystal ball it either. We want to always be able to sell someone out of something if they need to quickly, and we want to make sure everyone's successful in it and sells them and buys another one.
Yeah.
So we always want to make sure that we can really defend the sustainability of a business.
Yeah.
When you're doing a valuation, how do you go about deciding what you think is fair or sustainable?
Yeah, well, historic performance is key.
Yeah.
Most of the time, I'd say 90% of the time, we get nice, clean profit and loss statements, and it's relatively easy to look in the past.
Yeah.
Sometimes it's very challenging, and we have to again look at what is average competent management, really. So we'll benchmark it against regional areas.
Yes.
Occupancy data is pretty readily available.
Yep.
Along with our own data sources, and partnerships like this.
Yes.
Are fantastic in allowing us to benchmark these types of assets. So even with incredibly poor profit and loss statements.
Yes.
Which may reduce the number of purchases in the market for an asset like that, but we can still benchmark the asset to get to where we need to be. Yeah.
And then do you spend? We will talk about the report, but do you spend a lot of time looking into the management and how it's managed now?
Yeah, absolutely. Management is key.
Yeah.
It can fall away for a number of different reasons.
Totally, couldn't agree more. Yeah.
And it can outperform for various reasons as well. So management is key, and from a banking perspective, it's really one of the key drivers of risk, really, that they want to know that someone's got prior management experience, and if it's not in the motel space, it's some sort of business management experience, really, that we can apply to this and say they're probably going to be okay. So it's about sort of de-risking.
That's
as much as
interesting.
possible.
So when a bank instructs you, and I understand in most lending situations, the bank instructs you. When they do instruct you, do you then actually give commentary around the incoming purchaser?
Yeah, absolutely.
Yeah, right.
We'll talk to the brokers, and we'll discuss the management experience of those people. Because the bank wants comfort around, around the future success of this business. So even in troubling times like COVID, are they going to be able to manage themselves through that? So it comes down to the location of the asset, of course. There's some assets that will trade their socks off no matter what. But in trying times, which we've experienced more often lately, we absolutely need to comment on the quality of the management.
Interesting.
Yeah.
I didn't realise that was always the case.
Yeah, it's not a huge part of a report, but it's an important part. Yeah.
That's still interesting.
Yeah.
Joshy, what was your biggest surprise when you were looking at all the data?
That's a good
Or
question.
what do you think is the most interesting point?
I suppose if we compared it to the first year management rights report,
Yes.
We had 3 data partners on board for both.
Yes.
But because the motel industry is that much more segmented from an operational model perspective, we had to look at landlords, lessees, and the going concern model, and is arguably a bit more national than the management rights model as well.
Yes.
Just the sheer volume of slicing and dicing we could do with the data, with 1,700 sales over the decade, despite being comparable in terms of volume per year of turnover and similar scale overall, that sort of, I think it's 4,000-ish assets by memory.
Yes.
Just the fact that we were able to produce something as dense as this in year one with only 3 data partners, from a data nerd's perspective, that was really exciting. We've already had interest from multiple other groups about coming on in next year's edition. Some smaller firms, which will give us some more local coverage, as well as some bigger ones, which is really exciting because it helps paint a better picture of this industry for everyone.
Which is what we want. We want it to have credibility, right? Like the more information and the more data we can have in it, the better and the more respected it is, right?
Yeah. And so, in terms of something specific inside of the report, I would say, and it probably came out of our conversations as we were presenting it, because it was quite a work to get it done, and we were sort of revising presentations as we went from a transactional comparison point of view.
Yes.
And the real messaging there was how quickly the market was moving.
Yes.
We presented this in sort of an August period, and the data only went to the end of the financial year. So there was already a 2-month gap between, and 12 months prior to that was what we were really presenting as the latest. But we then had to start introducing some more recent sales. Just how over that 10-year trend that we looked at, each market had its, unique characteristics. But again, just how much the markets have changed in a short period of time compared to what was the historic norms.
It didn't change for years.
No, I suppose because you guys get much more direct market feedback than we do from the Val side, but how's it been received from your clients in the market?
Unbelievably.
Yeah.
And I absolutely agree with your point. I think there's going to be some institution. I think there'll be roll-ups, because I think it's one of the few industries that have the returns, and because now people understand it more, I think it's definitely going to be in the next period of time.
Yep.
And I think a report like this is exactly what is needed for people to make the jump on that and the ability to get enough scale. But no, it's been unbelievably. I think we could have done another 30 locations across the country.
Maybe not physically, but...
No, the wheels were coming off. The wheels were coming off at number 10, weren't they? But unbelievably.
Yeah, good.
Really good. And I was so interested in how the per key rate had jumped because, again, we'd never focused on per key.
Yeah.
Really, it was always a yield cash flow play, So that has been really, really helpful recently, where there's been a lot of buyers, really good businesses, a lot of buyers who wanted to buy them. But, I can think of 4 instances since that deal's been agreed where it's a record per key for the location, right? And so this gives people confidence that they're not overcooking it whilst you can't crystal ball.
Yeah, that's right. And if you don't have, if the financials aren't quite stacking up, there's a great alternative to look at, what the value of the place is. And motels are relatively simple to value when you pull it back to that
Totally.
very basic term.
Yeah.
Yeah.
And you look at the escalation in real estate prices, across most asset classes in the last couple of years. You would have seen for a motel in, I suppose the southeast Queensland market to push over that 300k a key threshold, again, was unheard of a couple of years ago. And there's certainly been multiple instances of that happening for the right assets, not willy-nilly.
Not everything,
But
yeah.
you say that, we sold a 3-star property, lease freehold, that we put back together.
Yeah.
I think it was the first one. But that went over, and now there's been a lot more and a lot bigger. But, I heard of a deal in play that hasn't settled yet, so who knows. But it's nearly 500. So it's moved exponentially. Like I know in Victoria when we did, and you obviously being from Melbourne, I know you cover the country, but it's your home state.
It is, yeah.
I remember when we did that deal in Bendigo and then the one in Wodonga, I think they were 330 or 340, and that was a challenge at the time, particularly Bendigo, which was the first one. It was the first deal we'd done straight out of COVID that settled. That was definitely a much bigger point with the valuer at the time. We got there because she could absolutely see that obviously it's a strong town, great historical trading, had been refurbished, but now with ADRs and occupancies being so strong, and with good operators being clever on operating costs, by not bringing back in daily cleans if they're not needed with corporate guests and all that stuff that the savvy operators have held on to, every deal now seems to be pushing and pushing, really.
I don't mean to be turning the table on you guys and asking too many questions, but from an agency side, how do you deal with an instance where there might be a sale there that you think could be difficult to value? Prior to the valuer coming out on site, are there steps that you guys take to to mitigate the risk of that transaction not going through?
Well, look, we're very aware that I'd say probably one of the biggest things we champion at Resort Brokers is to use specialists, right? It's such a niche industry. Make sure that people are talking to the right people. So like yourselves, specialists who understand the space, because it has got, like all industries, little nuances. But what we would do, right, is we would first of all ask a few experienced agents internally, which we do all the time anyway. So we'd throw it round to get different opinions and different ways of looking at it. Obviously, then we would throw it wide. Like we often have a lot of deals where it might not be comparable in that location, but there might be another town where there's a comparable deal that has the same drivers, the same amount of industry, the same population, the same number of keys. So we want to get really comfortable at that before we list it. We never want to list anything that we can't get through to settlement. That's what we think we're being paid for, really. The knowledge of how to do that and to foresee problems. So, we can't get there all the time. We'll turn down 1 in 3 listings.
Yeah, okay.
Right, because we just can't get there. And no one's paying us to market their property. Quite the opposite, really. And then we would, if it was really hard, we would start then obviously talking to you guys, and seeing if we're absolutely off the charts or if you have any other, which you always do, any insight. And then if needed, we would then get multiple offers and give you a campaign update to try and really defend that it's market value, right? And that it's not just one buyer who's first-time buyer and has more money than sense, which no one wants to do. That's normally how we try and circumvent it. But we'd cover it off really early.
Yeah, it's from a valuer's perspective too. I think it's been very noticeable just seeing the shift in educated buyers coming into the industry too. It's very rare these days that you're getting a contract land on your desk where someone's lobbed a figure out without some science or some some information behind it. And credit to you guys with this report. It's probably one of those assets that these people have access to now that gives them a lot more information on the industry than entering completely blind.
Totally. Although already the median is probably a bit low to what the market is now. What do you guys like to see? If there is a record-breaking deal, right, and obviously because you always want to have comparables to be able to provide the bank to give them comfort, what do you guys like to see in that situation? I'm sure you've all done that.
I think we've all valued a record sale at one point or the other.
A few sleepless nights.
Sometimes.
Yeah.
Still a few.
You certainly feel like you earn your fee on those reports, but it's look, I think first and foremost, probably the crucial thing to any valuation is certainty. Whether it's middle of the pack in terms of the yield that's been achieved, or if it's at the top end, you need to make sure that it's justifiable. And like Ryan said before, we're looking at consistent trading over a solid period. You're looking at average competent management. But look, for us, and probably the biggest thing the banks want to see from our reports in the case where you're valuing something that sits at the top end of the parameters or slightly above existing parameters, is just to be able to justify why. And they understand that there's going to be instances where it is the highest sale within that market sector, and that's okay. But you need to substantiate why it sits outside the parameters and provide a reasonable explanation that's going to pass through the credit process and the different departments at the bank that are probably reviewing our reports closer now than I feel like they have at any point in the past.
Really, that's interesting. Even though the properties are trading so well, like you would have thought compared to other businesses or industries, it's interesting to think that they're looking closer than they have. Yeah,
look, I don't think it's specific to our niche of the industry.
Okay,
I think it's across the board. And like every industry has gone the last couple of years, there's more checks and balances in place, and for the large part, that's a good thing.
Absolutely.
But certainly means that, it probably comes back to your point about using the right specialists in the industry, that you understand what they're looking for in our reports and making sure that they're addressed and not going to create any issues in that process as well.
Yes, I imagine that's an art too.
Yeah, it is you're certainly not crystal balling in terms of the figures, but you're crystal balling in terms of the risk aspect of the asset and making sure that you're addressing what the uncertain elements of that report are going to be. Yeah, addressing them up front rather than letting them become an issue down the line.
We act exactly the same way.
Yeah.
What about?
Yeah, no, it's a good point. I think the last few years we've had a number of challenges. We've seen record low profits and we've seen record high profits. So trying to find that balance of what's sustainable is difficult, and managing expectations. So we've got a lot of purchasers coming through that that want those future profits.
Yes.
And they're looking at projections and looking at the increasing revenues that have generally occurred over the last couple of years, particularly once you compare it to COVID. So sometimes we're having to look quite a fair way back historically to find what is sustainable. ADRs have gone through the roof, but in many places occupancies have yet to surpass 2019 levels. So broad revenues are still generally in line with 2019 when you take it back. And then there's other areas which are really hot tourist markets.
Yeah.
And because there's a massive domestic boom, we're seeing really strong results there and continued strong results.
Yes.
So there's a lot of balancing expectations, I suppose, when people buy these, and when they're entering the market for the first time, there's expectations are difficult at times.
Do you know what though? I totally respect your step in the process, and we try and train our team and make sure that we're not trying to ever push the envelope if we really don't genuinely believe that there's a sustainable factor, for the reason that it's just no good for anybody, you know. Then, look, it's interesting, isn't it? Because I think things are definitely normalising, but there's been a sugar hit, right? There's been a lot of money splashing around the economy. I've got to be honest, I thought this year, definitely there wasn't going to be... I thought domestic tourism might slow a little bit, and I've been very buoyed to see that no matter what's happening in the economy, Australians are going to holiday, every holiday. Take every minute of holiday they've got. And I'm also delighted to see that they may have gone over to Europe or gone and seen family overseas or friends, but that a lot of Australians have discovered Australia and are coming back for more. Is that what you're seeing?
Yeah, look, I'm probably a little bit biased on the southeast Queensland market, but I think we're coming into a particularly strong short-term accommodation period of the market. I think leading into the Brisbane Olympics in 2032, I think the number of retirees that are going to transition out of the workforce in the next couple of years will be a bit of a sleeper. I think that's going to drive a lot more tourism than people expect.
That's interesting. I haven't heard. Yeah, right.
But and the housing shortage is the other thing. I think that's going to absorb a number of rooms out of the market in the lower end motel sector. And we're already starting to see that in areas like Moreton Bay or parts of Logan, Northern Gold Coast, where there's alternate uses for motels there that are absorbing a lot of occupancy out of the market. So
Worker accommodation.
very much so.
Worker accommodation. We've done a lot of that too. We've done some converted to retirement homes. The government's buying them up for affordable living. In New Zealand, almost 50% of all the motels have been bought or leased by the government.
Is that right?
Long term? Yeah. And they were onto it years ago. Interestingly, particularly southeast Queensland, it's so underpinned by strata. Yeah. Right, management rights is such a successful model, and with the housing, with so many people downsizing into apartments, particularly in southeast Queensland, I don't know if the wider, even investors in the space are aware of how many keys might be moving from short term out of those pools. Yeah. They've actually stabilised, I think, this year, but there was definitely a run for a period of time, so huge population growth, the dollar's not strong, so people aren't going overseas as much. We are still holidaying. Nothing will stop us from doing that. It's a perfect storm, right? Yeah, I think so. Like you said, the short-term accommodation sector in particular has probably lost a few keys in the last few years to owner-occupiers moving in. That's stabilised though. It's stabilised without a doubt. Yeah. And going back. I think so. Curve, yeah. I agree with you. Yeah. And look, you can cut and slice the data so many different ways, but you look at the incentives out there for first home buyers coming in, and is that a concern? Yeah. Well, it probably provides another wave of investors in the market in 5 years that are going to hold on to these assets and feed them back into the letting pools at the same time. Yeah. So I think if you take a long-term view of this and sort of broaden your aspect from just looking at a 12-month window, we're coming into overall a pretty favourable period of the market. Well, I think what you're saying is that you don't think we're at the top of the market and there's a bit more to push it, Jordan, and I am delighted to hear that. I'll leave that to you guys to drive. Hey, tell us, Victoria, right? And again, no, you cover the country, but I think Victoria's a tale of not two cities, but two markets. What are you seeing down there?
Regionally going really well.
Yes.
Regionally going really well. There's a lot of deals happening regionally, and particularly in coastal areas, popular coastal towns or major regional cities. And the sub sort of $5 million freehold going concern market is really hot, along with the sub million 1.2 leasehold market. Yep.
Can't get
really,
enough of
really
them.
Strong. Yeah. Yep. really strong. When I speak to your brokers, there's often 100 inquiries and a handful of offers, and they're on the market for a couple of weeks in time. So, quality assets are going really well. Like a lot of markets, the things that have got a little bit of a problem are hanging around for a while.
Yeah.
So it is a little bit two-tiered, sort of, as always. The CBD is still struggling in comparison to pre-COVID, but slowly but surely, returning. But it is a slow return. It was COVID coupled with a huge supply around the same time has really sort of hit the occupancy hard there for most operators. But ADR, is going really well. So it's a slow move back upwards. Yeah.
I'm delighted that, because I think the operators, particularly in the CBD, are sophisticated. I'm delighted that they're holding rate rather than chasing occupancy.
Yeah,
Because
there's a lot of quality
there's
hotels
a lot of quality,
there now,
beautiful,
beautiful hotels now.
Yeah.
So, you'd be hard pressed to find anything, cheap there. ADR is holding up really well,
Yeah.
and so it
should
should.
be.
It's their quality. It's a quality
Yeah.
offering.
Yeah.
So.
Yeah.
So it should, and I love my city, so
I know.
I wouldn't want to see them too cheap down there, so.
No, and you know what? No one does events like Melbourne. You've got to give it, and no one does hotels, and no one does restaurants. So really, to be honest, hospitality,
right. Come visit
you
Melbourne.
kill it. Yeah. Absolutely. Do them a favour.
Yeah.
Come on down. I totally agree with your previous point, though. Whilst the market's like nothing we've ever seen, it's surprisingly price sensitive still. And whilst we are pushing the envelope and we are seeing record deals, particularly if you cut it per key and all the rest, it's still amazing how educated the buyers are and how if something's overcooked or if the operating costs in the P&L are too low, that how quickly it's dismissed.
Yeah. Wages are a big one, particularly
Yes, let's talk about
regional
cost.
or coastal areas. Sort of difficult to get locals working there is a real challenge for operators. They're having to house them a lot of the time, which potentially means giving up a room, or if a caravan park, it's a site. Or a house nearby, So,
of course, 3 or 4,
Yeah, if you're a pub or, a gaming operator or something like that, and you have to house a chef, there's lots of additional costs as to what there was perhaps 5 years ago, 6 years ago. So that's certainly one of the biggest challenges, along with a few other rising costs.
Insurance is something we're seeing a lot.
Insurance has been a big, particularly for caravan parks that are in both flood and bushfire areas, which there's quite a few.
Yes.
They're seeing a lot of challenges around insurance, even if they've been unaffected. There's a lot of cost challenges at the moment. Some of these assets, fortunately or unfortunately, depending on where you are, their seasonality allows them perhaps to close for a period, which negates some of those costs at times, and really forces them to make a lot of money in a really short amount of time.
But also how fabulous. You work 9 months a year and you make 12 months worth of income.
Don't have to pay a relief manager and shit off overseas.
That's a dream.
Or domestically preferred. So there's a lot of challenges for operators on the cost side at the moment.
Yeah, I would probably say that should be most people's focus for the next year or two, would be controlling those operating expenses.
Yeah.
I think there's probably a narrative that we've come out of a high inflationary environment and those costs are stabilising. But I think that's where businesses are going to see the most pressure on the back of a little bit of stabilisation on the ADR and occupancy side.
I agree with you.
Yep.
I agree with you. Totally. I think costs aren't going to stop.
No, not the ones that matter to operators.
Wages and so on.
Yeah, council rates, land tax, wages, insurance,
Insurances.
electricity, they're all directly impact the performance of a business, and I think they're costs that are going to continue to escalate in the next year or two. So the better managers get at mitigating those and mitigating their non-discretionary expenses outside of those items, I think they'll probably weather that little challenge the strongest.
Yeah, I would love to see that. I've never said it on camera, but I would love to see the industry work like the mafia and just not drop rate. Like really, we're under tariffed. We should be proud of what we've got. You know, there's not enough of it to go around. So operators absolutely should be holding rate. The challenge is when they start seeing compression and profit, they chase occupancy because some money's better than none.
Yeah.
But when cleaning costs and linen and all that stuff,
Race to the bottom.
it's a race to the bottom, and we saw that. I actually think we saw that in the motel industry. We certainly did in central and north Queensland after the mining boom bust. So I'd love the industry to do that. I think if there's one message, because I agree with you, I don't think costs are going to go. They're going to continue going one way.
They will, yeah.
Yeah.
And that's okay if you're aware of it and you're prepared to put steps in place to address it. And obviously the other challenge I think that's out there at the moment, and Ryan touched on it, is just the availability of labour and staffing.
Yeah.
Is that still a problem? You're still seeing vendors talk about that being a problem at the same rate?
I am, probably more so in southeast Queensland, probably more so in the coastal markets.
Yeah.
You look at, not that there's a significant number of motels left in some of these locations because their land values have escalated so much that a lot have been redeveloped, particularly caravan parks, I suppose, in the last couple of years. But you look at markets like Noosa or Broadbeach, and the rent that a cleaner or a back of house kitchen staff has got to pay to live in close proximity to assets in those locations.
Well, it's unfeasible, isn't it?
It's hard. Yeah, it's very, very hard.
I mean, I know running a business, it's wages continue to grow, and they should.
Is that right, Josh?
Something like that.
But they should, because it's just everything's so expensive.
Yeah.
Right? But then I still think ADRs, whilst they have grown, they started from a too low base.
Yeah.
Like, I don't think they're capped out at all, really.
Yeah, there's certainly some markets where it's probably getting a bit unaffordable, but there's others that are they're still incredibly they're incredibly affordable. Oh, look, booking holidays these days, you go Noosa sounds good, but other areas certainly got to play catch up, and there's still a race to the bottom in many areas that I see, because they still chase 80 plus occupancy, 90% occupancy, and it's kind of counterintuitive at times, particularly in rising wage costs. A good way to stop wages is just to increase the room rate, so you're cleaning less rooms.
You look like that isn't funny. I would say I would get the same result,
Yeah.
but I would say it's funny. I'd phrase it. Yes, I totally agree with you.
You'd probably put more of a sales
Yeah,
touch
I
on
would
it.
have, but exactly the same thing, but the other way. That's funny. But I totally agree that if you're at 80%, your tariffs are too low. Like, really, your tariffs can definitely increase because you've got so much demand. And if the guest isn't able to pay it at 80%, the next one will be. Make it worth your while.
Yeah, that's exactly right.
Yeah.
There's some markets they'll charge $100 for a night, but $30 goes towards a cleaner. And then you add in electricity and water and all the other costs, and all of a sudden you're not making a lot of money.
Well, you're servicing debt.
Yeah.
Normally, well, you should be, because when these returns, even with interest rates, still represents, you make money on the bank's money, in theory. I'm glad to hear that. I really think that should be our one takeaway.
We're always on the same page,
We
you
are.
and I. It's brokers and sales and agents and valuers. We're generally on the same page. There's a few outliers at times, which we've touched on, but for the most part, the buyers will lead the market for us.
Yeah.
So, we're not market makers. We'll read what the market's told us. So.
And that's why you guys are so good, because we can genuinely talk it through, hear each other's point of view on a deal, and I think that's so valuable and so healthy for the industry across the board.
Well, you'd get direct feedback too from the valuers, because the way, particularly in more recent times, the rapid movement of the market, unless we're up to date with the most recent transactions in that particular sector, you you run the risk of using out-of-date data, and
Yeah.
as a result, your number may not be reflective of where it should be. So
Yeah.
our need to be in constant communication with yourselves and your brokers allows us to provide the best advice to our
Yeah,
client.
and I mean the sales at the moment, they're evolving so quickly that 3 to 6 month old sales can be out of date quite quickly.
Without
So,
a doubt.
Yeah,
Without a doubt.
I mean data's super.
So glad we can add value to you, guys.
Well, that's the beauty of this partnership, isn't it? Like when we proposed it at the start, I wasn't sure how it would be received by the market, purely because data's valuable, but these guys have come on board, as have many other valuers happily in management rights and hopefully motels. But it's certainly like the way we've structured it, for those at home listening who don't understand it, like I become an open door in return for the sales data that we receive from our transactions. So it means that rather than chasing an agent who's constantly in and out of service and balancing 7 deals, you guys have a direct port of call who understands the data and who can give it to you at the drop of a hat. And I hope that helps you guys.
It certainly does. I mean, Optin as a business, we send out 10,000 valuations a week. Which is mental when you think about it. And we only do that with data, basically. We're a hugely tech-driven business.
10,000 a week.
10,000 a week, yeah. I was surprised at that number too, but yeah, we've...
Gosh, you must be tired.
Well, motels form a very small part of that. But data all the same is hugely important. We're a very tech-driven company, and we need the data. We need good in-house tech in order to produce results quite quickly. So these partnerships are enormously important. Yeah.
And long may they continue. Tell me, how can you use deals that are under contract or unconditional? If you don't have anything, can you mention them, or do you want to use things that are settled?
I'm a very big proponent or supporter of using the most up-to-date evidence that you can, and particularly when we're talking about such a niche market as the motel industry. And a lot of these sales, as you guys would know, the settlement times are taking longer and longer to roll through. So the delay by the time an asset settles to then being able to rely on it in a valuation,
it's moved again.
It has. So I like to make sure that I've got the most up-to-date sales in my report, but then you're also including an element of settled data as well that gives you that certainty that those transactions have run the course and seen it out. So, and that way you're also not hanging your hat on one or two sales in isolation. You've got a bit of a spread across the market, and you can talk as to why particular yields have fallen at a certain level, or why the key rate's at a certain level for that that asset in comparison to what you're looking at.
And we're always happy to, because it's good for the industry. We want to help you guys because that's what relationships are all about.
Oh, look, I'm surprised Josh hasn't blocked my number by now. I call him that frequently. So.
You know what, though, we do? We settle 200 a year.
Yeah.
And...
Plus,
plus, sorry. Yes.
Yeah,
Look at me underselling it, You're right, we settled 226 last year. So we've got quite a good snapshot, but we certainly don't have everything. Hey, guys, this is so good. We're going to come back and do part 2. And in that, we're going to drill in a little bit more into when you're engaged for our clients who are maybe looking to refinance or buy another one, or first-timers, what you look at and what your process is. So let's come back and do that. But thank you so much for joining us on part 1 of our fabulous data partners and the first ever Motel report. So thank you for joining us, and join us for part 2.
Thanks for having us.
Look forward to it.
Thank you so much for joining us at Resort Brokers Radio. Please subscribe and follow us, and give us a 5-star review so we can be back again next time. Thanks a lot.